Okay, let's just dive right in. Every year it's the same old question. Of all the money you get, what does the IRS actually get to tax? It can feel like you're navigating a maze, but don't worry. We're about to give you the map. Just think about it for a sec. You've got your paycheck, obviously, but what about that $100 your aunt gave you for your birthday? Or, a big settlement check from an accident? It's not always as clear as you'd think, and honestly, getting it wrong can be a pretty costly mistake. And here it is. This is the single most important thing to get your head around, the starting point for absolutely everything. The IRS's default position is that all money you receive is taxable income, full stop. From there, it's all about finding the specific official exceptions to that rule. So, what's our job today? Well, we're going to find those exceptions together.
Now, before we even dig into what is and isn't taxed, we got to talk about when something becomes taxable. And this is where a ton of people get tripped up. It's not about when that money hits your bank account. Nope. It's about a little something called constructive receipt.
You want to pay close attention to that phrase, available without substantial limitations or restrictions. That is the key. The IRS says your income is taxable the moment you have control over it, not when you actually go and deposit the check. The money doesn't have to be in your hand. You just need the unrestricted right to claim it. Let's look at a real-world example to make this stick.
So this illustrates the whole idea perfectly. Picture this. The landlord is out of town, right? Maybe celebrating New Year's. The check is just sitting there in a lockbox. He won't physically touch it or deposit it until January. But does that matter to the IRS? Not one bit. Because the money was made available to him without any restrictions, in December, it counts as December income. Period. Getting this timing wrong can actually lead to penalties for underreporting, so it really, really matters.
Okay, so now that we know when income gets counted, let's get into the what. Of course, our salaries are taxable, but the IRS casts a much wider net than you probably think. Let's run through some common examples. Yeah, wagers and salaries, no surprise there. But look at these others. Bartering? Let's say you're a web designer and you trade your services with a plumber. The fair market value of that plumbing work, basically what it would have cost, is considered income to you. A lucky night in Vegas? Yep, taxable. Even that small check you get for serving on jury duty counts as income. This example really hammers home the point about non-cash income. It's so easy to forget that income doesn't have to be actual cash. In this situation, the waitress has to figure out what that piece of jewelry is worth on the open market and then report that value as income. The IRS is crystal clear on this. Property and services you receive are just as taxable as dollars and cents.
All right, so we've gone through all the stuff that gets taxed. Now for the good news. There are plenty of situations where you can receive money completely tax-free. These are those specific exclusions we talked about right at the beginning. This is the list you're going to want to remember.
This is such a critical list. That birthday money from your parents? Generally not taxable. To you, anyway. Inheritances? Also excluded from your income tax. And importantly, money that's designed to help people through really tough times, like welfare, child support, or veterans' disability benefits, that's all specifically protected from income tax.
And this is a really powerful example of an exclusion in action. It makes no difference if this person is a millionaire or earns minimum wage. The tax code recognizes that this money isn't some kind of lottery win, it's compensation meant to make someone whole after a physical injury. So that entire $900,000 is received completely, 100% tax-free.
Now, some of these exclusions have some pretty important nuances. Life insurance is a perfect example of this. The main death benefit itself, generally tax-free, but how you choose to receive that money can actually create a taxable situation. Let's break that down.
So, let's just set the stage here. A beneficiary is supposed to receive a $75,000 payout from a life insurance policy. That core amount, the $75,000, that's the tax-free part. But the beneficiary often has a choice to make about how they get it.
And here's the fork in the road. You can take the money all at once in a big lump sum, and typically, it's all yours, tax-free. Nice and simple. But if you choose to leave that money with the insurance company and let them pay you in installments over time, well, they're going to pay you interest on that money. And that interest, that's brand new earnings, and it is absolutely taxable.
This table just makes it crystal clear. So in this scenario, the beneficiary gets a check for $1,000 a month. But not all of that $1,000 is the same in the eyes of the IRS. A piece of it, the $625, that's part of the original tax-free death benefit. But the other part, the $375, that's pure interest income. So every single check they receive is actually a mix of taxable and non-taxable money. So after all of that, what's the one thing you absolutely have to remember? Well, it all comes back to that simple rule we started with.
So here's the bottom line. Always, always assume that income is taxable. Just start from that position. Then, it's on you to find a specific rule or an exclusion in the tax code that tells you it's not. Whether it's a gift, an inheritance, or an injury settlement, you need to be able to point to the reason it's tax-free.
So there you have it. As you go about your week, I want you to think about the money that flows in and out of your life. After what you've learned today, what's one transaction, maybe a side hustle, a benefit you receive, or even just a tip, that you're going to see in a completely new light?